All right. So, well, thank you, Luohan Academy, for inviting me to moderate this session. Uh, I know Eric's paper for a long time. I think the first time I see it maybe was 2018. That just tells how long our publication process would take. And so Eric is the Paul McDermott Professor of Economics and Entrepreneurship at University of Chicago, and his CV is so long. I think going through all of them would take forever. I would just say one thing that I personally know that I've been working in the crypto space for a very long time. And the sad fact is that most of the academic work, when you talk to practitioners, they don't necessarily are familiar with. But there is one paper which is by uh, Professor Budish that was a long time ago was on this frequent batch auction paper. When I talk to everyone in industry, everybody knows about this, and they will refer to that. That just gives you one example of showing how much impact uh, Professor Budish has not only in academia but also just on the overall practice. So we are very excited to hear his insights about this paper on the economic limits of cryptocurrencies and blockchain. I think the floor is yours, Eric.
Well, thank you very much. I'm really happy to be with you all across the world talking about this research on the economic limits of cryptocurrencies and blockchains and what it means to produce trust at scale. And then Dr. Lee, thank you for your warm introduction. And I see my advisor is here with us today too, Alvin Roth, and I learned from his example how to do work in economic theory that can impact practice. And yes, the frequent batch auctions work has been having a lot of legs in crypto land because cryptocurrency markets actually have a version of the high frequency trading issues I've highlighted that's particularly extreme and um, because participants in crypto markets can actually manipulate the order of transactions in a way they can't in traditional financial markets. But I won't be talking about that research today. I'll be talking about more fundamental research on the economic and computer science innovations behind cryptocurrencies and blockchains and what I think are their economic limitations. So without further ado, let me get underway. Uh, the University of Chicago, where I work, is sometimes caricatured as being extremely free market oriented. But even at the University of Chicago, and even in its caricature form, economists widely agree that the market system requires some form of government and rule of law for support. You see this in the writing of Adam Smith, Friedrich Hayek, and Milton Friedman, whom I quote. Hayek spends about 600 or 700 pages in his book, The Constitution of Liberty, grappling with this paradox that to maximize freedom, you need a government with the power to imprison people, with the power to coerce. And Milton Friedman famously formulated the role of government as to set the rules of the game and to serve as umpire for the market system. And there's a lot of debate, of course, within the economics profession about what exactly the role of government should be in supporting the market economy. And there's a variety of views. But I think it's table stakes in the profession that some form of rule of law is necessary for the market system. Satoshi Nakamoto, in his 2008 paper and then invention of Bitcoin in the month and propagation of Bitcoin in the months that followed, um, it invented a new kind of economic system that can exist outside the reach of government and the rule of law. Trust and security instead arise from this quite ingenious combination of cryptography and economic incentives, all in a completely anonymous and decentralized system. The computer science terminology for what Nakamoto invented is permissionless consensus, the ability for a society to agree on what's true, on what the consensus is, without any named actors, without any support from rule of law without any kind of trusted authority in charge. So completely permissionless, free entry, free exit kind of system. I'll describe Nakamoto's invention in some detail shortly. But it enabled cryptocurrencies, including his own named Bitcoin, because a trusted consensus, a trusted database can keep track of who has how much money, can keep track of currency balances. And more generally, it's easy to imagine lots of other kinds of use cases for a trusted public database called a blockchain. And the idea behind Ethereum was to use the Nakamoto consensus, permissionless consensus idea, not just for currency transactions, but to maintain a kind of shared computer in the sky. And you can imagine other kinds of use cases for such a trusted public computer in the sky, maintained through a permissionless consensus outside the reach of any government. I think it's safe to say that Nakamoto's invention captured the world's attention. I don't say that lightly, but I think it's clearly true. Um, One statistic is just market capitalization of $4 trillion for various kinds of cryptocurrency projects. But I think even the $4 trillion figure understates just how much attention has been paid to the topic of blockchains and cryptocurrencies. But to date, economic usefulness, speaking here in spring of 2026, still remains an open question. It was an open question when I first started working on the topic in 2018, and it remains an open question in 2026. Uh, to date, the largest use case by far is financial speculation. And Dr. Lee mentioned my research on high frequency trading and frequent batch auctions. A lot of those issues show up in cryptocurrency markets too. The next most widely documented use case is various forms of illegal activity, seen cryptocurrencies connected and by diligent reporters to the online scam economy, online casinos, of course, terrorist groups, including Hamas, the Iranian regime, online sale of drugs, etc. Some of the illegal use cases I would describe as more sympathetic illegal activity, such as international remittances that circumvent cumbersome regulation. But I'll come back to that later if time allows. But illegal activity would be the second most widely documented use case. And the sources for this claim are a mix of academic and policy commentators, including the SEC Chair Gary Gensler, the Treasury Secretary Janet Yellen, and even Vitalik Buterin, the inventor of Ethereum, lamented that crypto is quote hyper financialized. And then I'll mention also a rich irony, which is that much of the financial speculation has been through cryptocurrency exchanges like Coinbase or Binance that are backed by rule of law. So trusted financial intermediaries supported by the government. And sometimes they're not even that trustworthy, as evidenced by the case of FTX and many others that I'll note later. So what this paper is going to do is it's going to argue that Nakamoto's invention, his novel form of trust, it's clearly ingenious, but I'll argue that it's fundamentally economically limited. And the Achilles heel of what Nakamoto invented, this permissionless consensus, is that the permissionless consensus relies on a kind of anonymous majority vote. And the issue with an anonymous majority of vote is that it's vulnerable to an attack by a corrupt majority. And the corrupt majority could be a corrupt majority of individuals participating in the system, or it could be a single individual who acts like a corrupt majority by obtaining a lot of cryptocurrency power, which could be work in the Bitcoin system or stake in the Ethereum system, et cetera. I think many people hear the phrase cryptography and assume blockchain data are secure, but actually you should think of blockchain data as secured by a combination of cryptography and an elaborate form of anonymous majority voting. And this is just true for all forms of permissionless consensus. And it's been an issue known to computer scientists since literally the 1980s, that even permissioned forms of consensus rely on an honest majority of participation. And the issue is in the abstract of the Nakamoto paper. So what I'm going to do in my paper is model this vulnerability to majority attack as what economists call an incentive compatibility condition. And this in turn allows for a kind of equilibrium reasoning that hadn't been done before for cryptocurrencies and blockchains, which allows me to make statements of the if-then form. If permissionless consensus were to become more economically useful, then it would have to get implausibly expensive to maintain the decentralized trust. And the costs quickly grow absurd. They could be more than all of global GDP in some of the scenarios I study. Whereas in contrast, traditional forms of trust, they're not perfect. Nobody, democracy is not perfect, but it's better than the alternatives. That's the famous line. Traditional forms of trust have economies of scale. So, for example, to support credible deterrence, the Gary Becker idea and implicit in a lot of what Hayek was writing, society pays a significant fixed cost to maintain a credible legal system. And then the credible legal system can maintain trust and safety at low marginal cost via the magic of credible deterrence. That's a kind of economy of scale for the production of trust that the traditional system has and that the crypto system lacks. The core of the argument's three equations. I'll get into them relatively quickly. But there's a zero profits condition, an incentive compatibility condition, and then an equilibrium implication. And the equilibrium implication is really the damning conclusion of the paper, which says that the cost of maintaining honest trust support has to be large relative to the value of attacking the system at all times. And it's just a very expensive form of trust, as you'll see. And it's particularly expensive as the stakes grow. It's a linear trust model. The cost of maintaining crypto trust scales linearly with the value that can be stolen. So that makes it implausible at economic scale without the support of government. And the intuition is just the Nakamoto trust system relies on anonymous majority voting, and so doesn't have the trust of the scale economies that come from law and credible deterrence. All right, so with that, let me get into the heart of the paper. I think we're going to take questions at the end, but if I'll let Dr. Lee, oops, hang on a second. I think I set a microphone issue. I'll let Dr. Lee interject with questions along the way. I'll just also be mindful of time. So I'm gonna spend a few minutes just going over what Satoshi Nakamoto invented, because I think for many of you this will be familiar for experts in the area, but I think for some of you might have a sense of cryptocurrency as being supported by cryptography, but not quite knowing what that means. So I'll spend a little bit of time there, and then I'll get into the heart of my of my analysis and its implications for why crypto is economically limited in its pure form. I'll spend a little bit of time towards the end on a way around my argument and really the reason why I think Bitcoin, for example, hasn't been majority attacked yet. There's been a lot of crime and theft and attacks in cryptocurrency, in the crypto economy. I'll flag some of those towards the end, but there has not yet been the large scale double spending attack I talk about for Bitcoin. I think the reason why is what I'll call specific capital and the risk of collapse. And then I'll conclude by comparing Nakamoto trust to the traditional trust system and then make a few concluding remarks and sketch some directions for future research. All right, so what did Nakamoto come up with? Think of a transaction as consisting of a sender, a receiver, an amount, and a signature. So, Alice sends Bob $10 signed by Alice. And cryptographic signatures can do a lot. They can prove the sender's identity, and they can also encode transaction details. So for those of you who remember sending checks, think of this as like signing a check and then signing the envelope that seals the check in it. Imagine that we're keeping track of these kinds of transactions on a Google document, on a Google spreadsheet. The cryptographic signature would ensure that only Alice can add transactions in which Alice sends money. But a Google Doc isn't really going to work for maintaining a currency, a serious currency, because users would have to check, does Alice have the money she's sending? Has she sent the same money to somebody else already? Has she sent money and then deleted that record from the Google Doc? So Google Doc doesn't quite work for keeping track of serious amounts of money, although it might work for keeping track of who who owes who babysitting services, for example, something lower stake. So among a trusted group. If we had a trusted party that kept track of balances, like a bank or a central bank or government, then the Google Doc would actually work just fine. But it requires a trusted party, and Nakamoto is trying to create trust without a trusted party. So what did he come up with? So the first step, I'm going to describe it in three steps. But the first step is really to describe the data structure that he's going to work with. This is not the trust model yet, but it will help us understand what he's going to build this trust model upon. And the data structure is what's called a blockchain. The blockchain data structure has data that lives in blocks. So a block, think of it as like 1,000 transactions at a time. And each block chains is linked to the previous block in the data structure using a hash. Using a hash is just a cryptographic idea that's been around for several decades. It's just a way of compressing a large amount of data into a very short alphanumeric string. For a block of data to be valid, each individual transaction in the block has to be correctly signed. Each individual transaction in the block has to be funded. Alice has to be sending money she has, given the history. And there can't be contradictions. Alice can't send the same money to two different people at the same time. So visually, here's what a block looks like. There's a bunch of transactions. There's a hash that connects this block to the previous block, and we'll forward connect this block to the next block. And each of these transactions has to be individually valid and kind of collectively valid given history and each other, as I described. All right, the next thing, and this is really starting to get into where the trust comes from. Who gets to add the next block to this data structure? And it boils down to a massive brute force search for a lucky random number. Free entry, free exit, all anonymous. What it means to play is it means to, on your own computer, to search for a kind of lucky random number, such that when your random number plus all of the transactions in the block, plus one extra transaction that's going to send you a personal reward, and that's part of the system, when all of that information is hashed together, the outcome has an astonishingly large number of zeros at the beginning. So this is an example block that has 19 zeros at the start of its hash. Each of these digits can be 0 through 9 or A through F, so there's 16 choices. So 19 zeros in a row is a 1 out of 19 to the 16 of that. And now I think it's almost 1 out of 20 to the 16. I'd have to double check. But this is hard enough to find that at present, the Bitcoin system is doing a trillion computations per second of lucky random numbers, trying to find one that's lucky enough to produce such an astonishingly large number of zeros at the start. And this is called proof of work. It's very hard to find a lucky random number, but easy to check. And the winner is compensated with newly issued Bitcoins, currently about 3 Bitcoins per block, worth about $200,000. So think $250,000 per 10 minutes for mining, for participating in this elaborate tournament. I took all of my colleagues' names and hashed them just for fun. Several of my colleagues, like Marianne Bertrand, has 2 leading zeros. Gene Fama's hash has the letters DFA at the start of it, which he's consulted for a long time, to David Booth's firm, Dimensional Fund Advisors. I think of that as a funny coincidence. But so this is where we are. So hashes can be used to connect one block to the next, and these hashes have a very large number of leading zeros. And then the third element of what Nakamoto invented is, well, what's going to convince participants to work on this elaborate lucky random number system and to regard the blockchain as the true record of transactions? And the third ingredient is called longest chain consensus. Once a miner finds a lucky random number, all participants are supposed to move on to the next block. And to induce this, Nakamoto said the true record of Bitcoin, the true consensus, is the longest chain as measured by the amount of computational work that's gone into it. And I think of this using 2 related intuitions. One is that as long as a majority of the computing power is honest and follows the longest chain, then the longest chain will stay longest with probability 1. It's like votes. And second, you need some decentralized way to coordinate miners' efforts. And there's been a series of papers that have proved that honest mining is a Nash equilibrium of an appropriately defined game, provided everybody's small. But the issue with the longest chain consensus, and the issue with any form of permissionless consensus, is that if the majority is not honest, if there's a large miner who's got 51% of the system and chooses to attack, they can create an alternative longest chain and rewrite history and steal a lot of money. I'll talk about that soon. So this is an excerpt from the Nakamoto abstract. He's just describing what he accomplished. He's just a solution to the double spending problem is making sure that the same money doesn't get sent to two places. And he concludes, as long as a majority of computer power is controlled by nodes not cooperating to attack the network, they'll generate the longest chain and outpace attackers. So I think it's notable that the abstract notes the double spending attack problem and the vulnerability to majority attack. It's right there. This is the issue he was working on, and he kind of forgot to check how things scale. There's a few clarifications in the paper. One is permissioned blockchains. Two is smart contracts. Let me briefly mention proof of stake, just because I get asked about this a lot. Roughly, proof of stake is instead of voting for the correct chain with computational work, vote for the correct chain with stake in the cryptocurrency. Most famously, Ethereum uses this trust model now. And my paper's three-equation critique, which I'll get to in just a moment, applies to all forms of permissionless consensus, including proof of work, proof of stake, proof of hard drive space, whatever you like. Dr. Lee noted that the paper's been around since 2018, but it really became quite general later in the publication process. So initially, I was just talking about Bitcoin. And there's a subtle security advantage to stake over work that I'll come back to at the end of the talk if there's time. This is something I've been working on recently with Tim Roughgarden and Andrew Lewis Pye. Okay, so let me give you the three-equation critique. Equation one's a zero profit condition. The conceptual question is how much trust support will maintain the permissionless consensus if we restrict all participants to behave honestly. So the quantity we're going after is capital N, an amount of trust support, again, computing power, stake, etc. It costs C per unit time to provide 1 unit of trust support. So think of this as the rental cost of capital and variable cost of electricity from running a computer, or a rental cost of capital for stake, opportunity cost for stake. And then little p block, is the compensation paid to the player that adds the next block. I'll skip the details of the block difficulty level and just get to the first equation, which says that in any zero profit Nakamoto trust equilibrium, N star C equals P. So what does this say in words? What this says is that if the system pays, P right now is about $300,000 about $250,000 per 10 minutes. If the system pays $250,000 per 10 minutes, how much entry will there be? Well, the amount of entry, N star, will be roughly what it takes. Will roughly dissipate that $250,000 per 10 minutes. Participants in a tournament, in a rent-seeking tournament, will spend roughly the stakes. That's an old idea. It's credited to Tulloch and others. This equation shows up in my research on high-frequency trading, where the prize is the opportunity to extract small amounts of rent in financial markets, and then N star is how much entry is there into ultra fast trading. All right, so that's equation one. And equation one preceded my work in a variety of papers. Equation two is the incentive compatibility condition, which is novel to my work, and just asked, well, how trustworthy is this $300,000 per 10 minutes of trust support? How much security does it generate? And the vulnerability is a majority attack. So again, the well-known Achilles heel of all forms of permissionless consensus in the Nakamoto abstract and in the 1980s computer science literature, and what's now called permissioned consensus. But with permissionless consensus, you have to think about an attacker's incentive to become a majority, because they can do so anonymously and in a very decentralized and disguised form. So we have to really think about incentives. So the incentive compatibility condition, I'll skip to the equation and just describe the ingredients in it. What this says is, well, if there's n star C units of honest trust support, and an attacker comes at the system with more than that, with A star more than that. So A star is going to be a parameter that describes the size of the attacker's majority. So A greater than 1 describes that the attacker has a majority. So A of 2, for example, would mean the attacker's got 2/3. So the attacker comes at the system with A star more than the honest majority and does so for an amount of time t that might depend on the size of the majority. It might be slower to attack with a 50.0001% majority than with a 99% majority. These are going to be the costs to the attacker of attacking the system. And it better be that these costs of attacking the system are larger than the benefits of attacking the system, capital V. If not, then it's not going to be incentive compatible. Somebody's going to choose to gain a majority of the trust support to attack the system and gain capital V attack. And this is an equilibrium incentive compatibility constraint for an outside attacker. An attack from the inside is actually cheaper by about half. And it's a gross cost of attack. I'll come back to the distinction gross versus net in just a few slides. So the problem is, let's put these two equations together, where equation 1 is the zero profit condition. It says how much trust support is going to enter the system honestly. Well, it depends how much you pay for it, P block. And then equation 2 says, well, how much trust does this honest trust support generate? Well, it better not be that V attack is really large relative to the expenditure on honest trust support, or else someone's going to come at the system and spend a little bit more than the honest trust support and steal a bunch of money. You put these two equations together, n star C shows up in both of them, and you get an equilibrium constraint, equation 3, which says that P better be bigger than V with a constant in the denominator. So what does that say in words? It says that the per block payment for trust support has to be large relative to the benefits of attacking the blockchain. You just stare at this equation for a second, and you'll notice that if capital V grows by, for example, 1,000 times, little p has to grow by 1,000 times too. This is what I mean by the linear scaling problem. So let me make a few remarks about this equation. So first, just economically, it's a deeply expensive form of trust. So imagine if users of the Visa network had to pay fees to Visa every 10 minutes that were large relative to the value of a successful one-off attack on Visa. Or imagine a country that was only as secure as its flow expenditure on soldiers at the border. From a computer security perspective, the security is linear in the amount of computer power, right? If V attack goes up by 1,000-fold, P has to grow by 1,000 as well. It's 1,000 times more expensive to prevent a $1 billion attack than a $1 million attack. The net cost of attack's different from the gross cost of attack. I'm actually going to skip this in the interest of time, other than to flag a theorem that says that under stylized zero friction kinds of conditions, the net cost of attack is actually going to be zero. And this is actually Josh Gans and Hannah Halliburton recently generalized this result and found that the net cost of attack can actually go negative. And that tells us that there's going to be friction. And actually, the friction I'm going to point to is right here. That I think if someone were to majority attack Bitcoin, the value of Bitcoin would fall, and possibly dramatically. Can do the analysis I've done so far in a one-shot game. I'll skip this too in the interest of time. But this one-shot game version of these three equations might be the version I would teach to undergraduates. And the statement is that the question we can ask is, under what conditions is there a Nash equilibrium in which all players choose the honest posture? And the result is that a necessary condition for the existence of a Nash equilibrium in which all participants play the honest posture is P greater than V. And this is in a one-shot game version of my analysis. And the proof is 5 lines. I encourage you to work through it with your undergraduates. But what I will spend time on is the graphic novel version of my argument. So this will show you my tastes, I guess. Uh, Imagine there's a robber thinking of robbing a bank. Um, in the traditional security model, there might be security guards outside the bank, but the real source of deterrence is the police and courts in the background, right? So the reason it's not incentive compatible to rob banks is not just security at the bank, but all of the trust support in the background. The Nakamoto trust model is like a ton of security guards. It's like there's 1,000 security guards at the bank, but if I come at the bank with 1,200 armed attackers, I can rob a lot of money. And if the bank says, I know, I'll use 10,000 security guards, well, then I can come at the bank with 12,000 armed attackers. It's just a very linear security model that won't scale if enough money is in the bank waiting to be stolen. So I can do a lot of quantitative analysis of double spending attacks. Briefly talk about this part of the paper too. What a majority attacker can do, actually, let me skip this slide and just go to a visual, is they can send a bunch of money to financial exchanges, banks, other crypto financial institutions, wait for that money to pass any escrow periods, get assets in exchange. But in parallel, an attacker could work on their own private chain that is longer. And if the attacker has a majority, they can do this strategy with probability one. And then this alternative chain becomes the longest chain. And this money that they sent to banks, exchanges, et cetera, actually the banks, exchanges, et cetera, no longer have. So the attacker now would have the assets that were released to them plus their Bitcoin back. So they would have successfully double spent. And we can use that equation I showed you earlier to quantify this equilibrium constraint. I can explicitly solve for t as a function of a star. So how long would it take different size attackers to attack the system? And then explore, well, what does that mean for how large the cost of trust has to be relative to the value of attacking the system? Let me go through one of the main results of that analysis. We look at a per block basis, I find that security has to cost 5% of the value secured. And this comes from equation 3 rewritten, where the 5% is 1 over 20, where 20 is the number, it happens to come to almost exactly 20.00, the number of block compute units that it would take on average to successfully double spend against Bitcoin using Bitcoin's traditional 6-block escrow period. The reason why it's not 7 or 8 is just it's a stochastic system, but 20 is the average. 5% per block doesn't sound crazy, but that comes to 720% per day or 262,000% per year. And this is security costs as a percentage of the value secured against attack. So if an attacker could steal $10 billion, the costs per year is 26 trillion, that's 25% or so of the global economy. The attacker could steal $100 billion. It's a lot of money, but it's actually not that big for the traditional financial system. It would cost more than the entire global economy to keep this form of trust secure. And that goes to show just how much economy of scale we have in the traditional financial system that we just take for granted on a day-to-day basis. Costs per transaction might not sound huge, but even a transaction for a cup of coffee at Starbucks would have to pay the security costs implied by keeping gold secured Fort Knox. It sort of doesn't work as a trust model for small transactions either. There's a level 2 idea, which I might come to later if there's time, which is more sensible. You can do sensitivity analyses. That doesn't really change the picture much. I'll skip this slide. The takeaways from this double spending attack analysis, it's consistent with modest use cases of Bitcoin, like black market or computer parts. It's consistent with larger scale black market uses of Bitcoin because these might be users willing to pay high transaction costs. But it casts doubt on Bitcoin style trust as a major component of the mainstream global financial system. It's just too expensive. And this surprises, I think, to computer scientists. And I take this from my conversations back in 2018 with various computer scientists. I got to talk about my work with Vitalik Buterin, founder of Ethereum, and various other computer science-oriented participants in this world. Two surprises that are related. One is that for the system to be secure for large transactions requires transactions costs that are really quite ridiculous for small transactions. And then two is a kind of order of quantifiers point, just that a long enough escrow period isn't enough for security. And the source of both of these surprises is I think the computer science community wasn't engaged with the equilibrium reasoning that one needs to worry about larger and larger attacks if Bitcoin and Nakamoto Trust become more economically useful. So in economic terms, security is not a 0-1 property. It's more like a very high percentage tax. And what my research shows is that the tax of keeping the trust using the Nakamoto method is actually has to be really high. All right, so there's a way out of my argument. Let me just do a quick time check. Try to spend about 10 more minutes on the paper and then allow for questions and Q&A. There's a way out of my argument, which is the combination of specific capital and collapse. So Nakamoto in 2008 envisioned ordinary computers being used to maintain Bitcoin. But for the last 10 plus years, since 2013, Bitcoin's been dominated by highly specialized equipment called ASICs, application-specific integrated circuits. And these are not just efficient, more efficient than CPUs, but they're dramatically more efficient than CPUs by factors 4 to 6 orders of magnitude are the kinds of numbers I've seen. So it's specialized equipment. And with proof of stake, the capital is specialized by construction, stake in the specific cryptocurrency. And if the capital is specialized, and two, the attack actually causes not just the attacker to steal a bunch of money from Goldman Sachs, but actually causes the specialized capital to lose its value too, then you need to rethink the attacker cost model. So if a majority attack caused the value of Bitcoin to plummet or caused Bitcoin specialized computers to lose their value because the Bitcoin community, changed the hash function, then you need to charge the attacker not just the $300,000 per 10 minutes of compute costs, but the 10 to 20 billion dollars of the specialized capital that they're using for a short amount of time. So that instead of charging the attacker a flow cost, order n star little c, you have to charge the attacker a stock cost, O of n star big C, where big C is the fixed cost of the capital. This is a picture of a Bitcoin ASIC machine. If you had all of Amazon Web Services, if you had all of the computers running AWS or all of the computers powering the modern AI firms, it would be a tiny, tiny fraction of the Bitcoin hash rate. I compute about 0.05% for AWS. And the reason is the specialization. The specialization is really quite dramatically powerful. If the attacker were to lose their capital value, can rewrite my equations 1, 2, and 3. The key rewrite is equation 2, where now the fixed cost of capital to attack the system, n star capital C, has to be larger than the value of attacking the system for the thing to be incentive compatible. And these equations allow me to calibrate how much capital is actually in the system as a function of parameters. And I can actually match this against retail prices. And what I find is that it's consistent with about $12 billion of capital currently being used to secure Bitcoin. I think that number's probably gone up. And an equilibrium constraint that is much more secure than before because of this parameter little r here, which is a rental cost of this capital per unit time. And a unit time is just 10 minutes, so little r is tiny. So the bottom line is if the attacker were to lose their capital, rather than just have to rent a large amount of capital for a relatively short amount of time, the security model is 3 orders of magnitude improved, about 2,500-fold improvement in the cost of security. The issue is, how does the attacker lose their capital? And there's 3 possibilities, each of which are pretty problematic. One is the attacker causes the cryptocurrency to collapse altogether. which makes attacks expensive. It's why Bitcoin's safe to date, but it's hardly reassuring because honest participants are hurt too, and a single attack could cause a collapse of the system. So it's a form of financial sabotage. So you worry about bad actors attacking the system. Second is what I call internal to protocol punishment without collapse. And this is what Ethereum, is trying to do with their idea of slashing. And I study this in recent work with Andrew Lewis Pye and Tim Roughguard. And this is also a quite ingenious idea. The idea is to use uh, Ethereum as a slightly different consensus model than Bitcoin. And the key difference from the perspective of this paper is that the capital lives on chain, and the uh, each block, the capital has to sign each block. I'm paraphrasing a little bit. But so if someone double spends, they'd leave a form of proof that they'd acted badly, that they'd signed conflicting blocks. Um, so this can create the basis for an in-protocol punishment of a bad actor. But the problem is this bumps up against its own impossibility theorems, where a large enough attacker can basically control the protocol's legal system and prevent the protocol from attacking. There's basically no way around the vulnerability of a permissionless system to a corrupt majority. And computer scientists have kind of known this since the 80s. Um, and then third is an external to protocol punishment from the rule of law, which would certainly work. So if an attacker double spent against Goldman Sachs or JP Morgan, you can imagine them calling in the feds for help getting their money back. Um, the question of this paper is whether Nakamoto Trust is economically viable without the government rule of law in its proposed form with its proposed advantages. My best guess is that cryptocurrencies security to date is a combination of factors one and three. So there's the risk of a dramatic collapse, and then also a little help from rule of law. And the help from rule of law, I would note the irony, which is that cryptocurrencies have been used for a lot of criminal activity, but might be in the background protected against dramatic majority attack from some help from rule of law in the background. So let me just compare Nakamoto trust to traditional trust, and then I'll conclude. So for concreteness, consider a financial transaction between two parties of size V, where one of the parties can cheat and steal the other guy's assets. So party one chooses between engage and don't engage. Party two chooses between honest and cheat. Uh, if party one plays engage and party two plays honest, both parties get a small benefit from transacting. I'll denote that by little b. Party one plays engage and party two plays cheat. However, party two steals all party one's money. So party two gets plus v and party one gets minus v. So they don't get the benefits from transacting. Instead, party two just steals my money. So the equilibrium in the game described is just for party one not to engage so that party two doesn't steal their money. Now let's add a legal system with the power to enforce contracts. So if party two cheats, party one can bring the matter to court. And let's say the court's perfect. Let's say the court can observe that party two cheated, can compel party two to return party one's assets and pay a fine. So what are the payoffs here? Well, party one had to bring the matter to court. That costs some money. And party two had to pay a fine, possibly life imprisonment, and it could be a big fine. But that's their payoff. And the equilibrium now is that the legal system makes it an equilibrium to transact honestly. The threat of enforcement if player two cheats makes it actually an equilibrium for player two to play honestly. And the thing that's beautiful about this form of trust is that on the equilibrium path, the court doesn't have to be involved with the transaction at all. The court just has to be there in the background. Societies that pay a fixed cost of operating a legal system can facilitate honest transactions that have zero marginal cost of security because of credible deterrence. This is in Becker, it's in Hayek, if you're in thinkers before Becker and Hayek, and going all the way, maybe John Stuart Mill. This goes back a while. And if you think about other kinds of trusts that show up in the economics literature, in the literature on repeated games, so brands, reputations, relationships, etc., these also have the flavor of economies of scale in the production of trust. these often work in conjunction with rule of law. So you actually study John Levin's job market paper on relational contracts. There's a lower bound payoff to what the worker earns if their boss doesn't follow through on the relational contract. And the lower bound is the promised amount of salary in the written part of the contract, as opposed to the relational part. So, rule of law and repeated game sources of trust often work together, sometimes implicitly. And collateral is a particularly important kind of trust for finance. And collateral is actually really cheap because of the Modigliani-Miller theorem. There's a table in the paper that goes through all of these different trust models. On Nakamoto in its original form, the cost of breaking the trust is a flow cost. It's low. And the variable cost of honest play is high. It's this P block per period. Trust that comes from repeated interaction, the cost of breaking trust is a stock cost. It's higher. If I cheat you, I lose my relationship with you. And the variable cost of honest play is actually zero. The variable costs are zero given the pre-existing trust relationship. Credible deterrence, what's the cost of breaking the trust? Well, I can get thrown in jail for the rest of my life. And the variable cost is the security guards, the minimal layer of variable cost needed to monitor and conduct enforcement. What about collateral? The cost of breaking the trust is I lose my collateral and maybe I go to jail or I get punished in some other way. And the variable cost of honest play is zero under the conditions of the MM theorem. And then I talked about Nakamoto with collapse, and the cost of breaking the trust is now higher, but has this collapse risk. And I alluded to proof of stake. I'll skip that in the interest of time. For the traditional financial system, we can upper bound the cost of trust by $1 trillion. This is a quite conservative upper bound. In the United States, spending on police, prisons, and courts is about $300 billion a year. The financial sector's value added is about $800 billion a year. Both of these numbers include a lot of stuff that is not just about trust. So you can use $1 trillion as a conservative upper bound. And transaction volume in the United States financial sector easily is in the quadrillions of dollars a year. I computed this with a recent paper with Adi Sundaram. So you can conservatively bound the cost of trust in the traditional system by 0.1% of asset volume. And many fees in traditional finance, especially for large transactions, are 0.01% or less, so a basis point or less. And the traditional financial system is by no means perfect, but the comparison with Nakamoto Trust is night and day. Nakamoto Trust is just dramatically more expensive and implausible for real money. So let me conclude. The anonymous decentralized trust invented by Nakamoto, my conclusion is ingenious but expensive, implausibly expensive. Permissionless consensus has to date been of limited usefulness in its pure form. And my work suggests this is intrinsic to the technology. It's consistent with the continued use of this technology for black market activity. It's also consistent with the usefulness of this technology where we're using the data structure but with traditional forms of trust. So permissioned blockchain, distributed ledger technology, these are terms used to describe the data structure but with traditional sources of trust. So CBDCs, I think, are a good idea. They're anchored in traditional trust from rule of law and the reputation of central banks. They would reduce a lot of rents in the traditional financial system, so they're not very popular. But anyhow, what this paper highlights is that it's exactly what makes Bitcoin and Nakamoto Trust so innovative relative to traditional distributed databases, the anonymous decentralized trust that's the source of its economic limits. So let me conclude. In recent talks on this topic, and you can find slides on this on my website, I talk about a lot of open questions and directions for future research. I gave an AEA recent developments lecture in January if you want to watch a video version. But topic one was potential solutions to the problem I raised in this paper. Topic two is blockchain for traditional finance. Topic three, crypto as a social and financial phenomenon. Topic four, crypto data for financial research. And then topic five, crypto and political economy. I won't talk about those today, just in the interest of time, but I will give you an overall conclusion, which is crypto trust in its pure form doesn't work at scale. Crypto trust in combination with rule of law, I think that's what we're seeing a lot of recently, and that a lot of the financial speculation is crypto trust in combination with rule of law. You can buy Bitcoin ETFs from BlackRock on the New York Stock Exchange, regulated by the Securities and Exchange Commission. So is that Nakamoto trust or is that old-fashioned trust? It seems to me um, uh, quite dangerously speculative, but what do I know? There's a lot of interesting computer science. There's a lot of open conceptual questions. I think it's a great area for research. Um, the high level advice I have for researchers in this area is to use crypto data to study questions of broader interest to economics and finance. So trust, bubbles, crime, financial regulation, political economy, and so forth. Um, I get asked a lot about crypto prices. At some level, in my long run predictions, I think they'll be very low. But in the short run, I don't know. I'm confident in continued low economic usefulness of crypto in its pure forms. A lot of the activity looks to me like what Schiller called a naturally occurring Ponzi process. So kind of a bubble, a Ponzi scheme-like dynamic, but where there's no magic man behind the curtain. It's more of a social process. But I've been saying that for a long time. So the two last things I'll say. So first, while there hasn't been a majority attack of Bitcoin or another major cryptocurrency yet, there have been a lot of attacks on smaller cryptocurrencies and a lot of large dollar thefts of crypto projects and collapses of crypto financial entities. So I think my calling attention to the limitations of the cryptocurrency trust model since 2018 at this point, I think that has been validated by the record. I'll give you a few slides uh, of data on that. So here are 51% attacks of the forks off of Bitcoin and Ethereum, all of which actually happened since my work came out in 2018. Bitcoin and Ethereum forks, attacks of various crypto financial entities, many in the hundreds of millions of dollars. Here's a second slide of attacks of crypto financial entities. Here's a third slide of attacks of crypto financial entities. And then collapses of crypto financial entities, most famously Terra Luna and FTX. So it's the notion that there are limitations to this form of trust and that it's vulnerable to collapse, I think has been borne out by the data. And let me just leave you with the Bitcoin community's opinion of my research. They'll give them the final word. And here's their feedback on my paper. I've never been given dumb fuck juice in person, but I've been given it on the internet, and it's really quite tasty. Thank you very much for your time and attention, and I'll look forward to your questions.
Great. Thank you so much for Eric for this passionate talk. So I think there are already two questions. I have some questions, but I think I'll leave the audience to ask first. I think the HUU who has the first question first, and then Long Chen has raised the hand. So maybe you go one by one. The who HUU's question I think is in the chat. After all countries in the world became capitalist countries, it's definitely possible for all economic, financial things and all activities of all countries to be placed on the same blockchain. If possible, in the final analysis, how exactly is it possible? In the final analysis, no one must always trust the most before they dare to put all of this on the same blockchain.
Yeah. I think I get the question, the sense of that question, and the book I would recommend that um, um, folks interested in that question read is Hayek's Constitutional Liberty from the 60s. And it's sort of this and I recommend it sort of with a smile on my face. It's a very difficult book to read. You're sort of in the presence of a genius who seems like ChatGPT before there was ChatGPT. I don't know how he knew all the different stuff he knew, but it's, massive quantities of footnotes, but he's meditating on where on earth can trust come from? And it kind of has to come from a social equilibrium with government and force. I think one blockchain to rule them all is a little bit of a utopian fantasy. I think a lot of people read utopian fantasies and get taken in by them too. But Hayek was really grappling in a thoughtful and sometimes confusing and rambly way with where on earth does trust come from? I think it ultimately comes from we're lucky that we have functioning governments that support the market system and support trust, and we often take it for granted. Um, and I think if my research can help people take it a little bit less for granted, that will be one unexpected positive consequence of my research.
I think Lon, you have been raising your hand.
Oh, yes, Eric. Um, Thank you very much for the interesting talk. It's really propelled me to think about the issue. I have several questions. I'm trying to fit your theory with the reality. So the first question is, um, if I believe your major conclusion is that with the pure form of this crypto kind of the uh, completely decentralized economy, the cost is not bearable at the macro scale.
Correct.
So my first question is, what is the limit of this economic scale? For example, actually, at early stage, for example, Bitcoins, people complain that it was actually costly to transact anything because there's no trust. But actually, Ethereum and other platform and they actually have largely reduced the cost of verification. And now with this trillions of dollars, the world seems to, uh, it exists. So I wonder how big is the limit of this world, or the breakdown is bound to happen. What exactly do you mean that there's a limit at a scale is not sustainable? So
Well,
that's the first question.
I think I get the question, and I think the system. Cryptocurrency does not seem like it's in equilibrium. And let me try to be a little precise about what I mean by that. What I mean by it is it has at the moment it has a high-ish market value, trillions of dollars. It's a lot of money. Um, it has low usefulness, with the exception of the primary exception has been illegal activity, and well, financial speculation and illegal activity. Um, there's some, you'll hear arguments in some corners about usefulness of stable coins, and I think that usefulness can be replicated with, in the United States, we have technologies like Venmo and Zelle and others that allow, stable coins aren't particularly value added relative to those unless you're trying to transact anonymously. Um, but I think the short answer to your question is that it's not equilibrium to have a very high valuation for something that has very low usefulness. So something will give eventually. Either I'll be proven wrong and crypto will become very useful, or crypto will be proven wrong and lose its value. And reasonable people can disagree on that. My view is that uh, crypto will not become useful in its pure form. I think one other thing I'll say is I think policy has backed itself into a corner. Sometimes it's been lobbied quite aggressively to do so. Whereas there's now actually a fair amount of implicit and explicit legal support for cryptocurrency, in the United States and in other countries, um, even though the core technology is quite anonymous and convenient for criminals. So the governments have gotten themselves into the situation where it used to be that if you wanted to transact large amounts of currency illegally, you had to carry suitcases of $100 bills. Now stable coins and Bitcoin are a much more convenient alternative. And the US government recently blessed stable coins over the summer, in the so-called Genius Act. I think that act was a mistake. I'm on record saying so. Um, but the Genius Act doesn't grapple with the distinction between permissionless and permissioned stablecoins. I think a stablecoin run by a bank like JP Morgan with identity and rule of law and all that would be fine. And then we would want to try to think about rents and whether excess rents would accrue to the financial institutions maintaining the ledger. But a permissionless stablecoin is intrinsically vulnerable to criminals. And we now have the U.S. government legally blessing permissionless stablecoins. I think that's a mistake.
Well, so I guess I'm not sure you answered my question, but my key from what I'm listening, what you're trying to say, you're not really trying to argue whether a cryptocurrency is useful or not. You're trying to say that it is vulnerable in some way. So I would recommend you to stay that way, because you are not trying to prove it's useful or not, because we don't know yet. And but anyways, but I'm trying to
Well,
get to a
let me
point.
interrupt. It's been since 2008, so I think we have 18 years of data that suggests that
Yeah,
it's not been useful yet. And as I showed you over
right,
the last 5 slides, there have been a lot of attacks, thefts, and collapses,
right.
many of which in the hundreds of millions to billions of dollars. So it's very
My,
there's this set of
you
interest.
see, I guess
Let me
my
finish that. There's this set of
okay,
interest that has a lot at stake in my argument being wrong, but I want to confidently defend my argument being right. And I acknowledge that a lot of people disagree with me, and a lot of people have a lot of money on the other side of my
right.
argument.
My point is that you are not proving this in your article, because that I don't think how useful it is not the key part of the article. If
The
I'm
title is
getting
Economic
right.
Limitations. I think that's about usefulness. But we can, if you choose to disagree, that's fine. I'm okay with that disagreement. I mean, the
Uh,
word usefulness
okay,
is all over my
so
argument.
let me follow up with the second question. So, how do you think your model is predicting or fit the current stage? The current stage is that it's really the mix of it's clearly not a pure form anymore. It's you can say it's the current financial system integrated into this so-called Web3 stuff. Starting with the Genius Act stuff, then now there's crypto assets, stuff like that. So is that a prediction, a rational prediction of your model? Is that inevitably it should evolve this way? Would you agree or what?
I think I'll repeat myself. I think the current there's some out of equilibrium to the current state of affairs. The current state of affairs has a combination, two salient features that I just want to note for the audience. One is high valuations, low usefulness. And then two is
Right,
a strange interaction with rule of law, where there's actually quite a decent amount of support for cryptocurrencies from the rule of law. Coinbase is registered with the SEC. The Genius Act legally blessed permissionless stablecoins, even though the underlying assets are anonymous, convenient for criminal activity, and vulnerable to majority attack. So that's two different ways in which the current state of affairs feels non-stable for the long run. But where things go from here is very hard to predict, certainly in the short run. And a lot of people have made a lot of
okay.
money disagreeing with me.
Okay, I have a final question. So at the micro level, how does your theory imply for DAO? You know, DAO is the decentralized autonomous organization at micro
Yes.
levels, and people suspect that it will be very hard for organization without any kind of legal or stuff like that is going to work. It's surely there's a lot of boundaries, and I think Ben Holmstrom used that, and I discussed quite a bit on this. We think this has a lot of the so-called smart contract stuff, like a lot of mutations. So, does your theory has some implication for the limit of DAO?
Yeah, I think so. One of the attacks on my lists was a DAO attack where a an attacker, it was founded by some students who I've gotten to know who were from the University of Chicago. A crypto project called Beanstalk, and there was a malicious proposal to the Beanstalk community that was the name of the proposal. So a DAO is a decentralized autonomous organization. It's a way of, in a decentralized way, stakeholders in a crypto project voting on stuff. So someone proposed to this particular DAO a vote to send $250,000 to Ukraine right after Putin had invaded at, at the start of the war. So it was a very sympathetic looking proposal. It passed. It got a majority of votes from the DAO. And in the DAO, in the code of this proposal was actually malicious code that siphoned all of the crypto project's funds to the attacker. And actually, the attacker proposed the proposal and also, in a flash loan, borrowed a lot of money, borrowed a lot of stake in the project to then vote their own proposal in. So it looked like all was on the up and up, like the DAO was supporting a nice donation to the people of Ukraine. But in fact, it was a corrupt majority attacker who stole $100 million or so from a crypto project. So DAOs are vulnerable to anonymous majority attacks, just like Nakamoto consensus is.
Got it. Okay, thank you.
Thank you.
Okay, so I think we are kind of behind schedule, and there's a lot of very exciting questions. I think the value of academic research is to not necessarily just to bring a message, but beside that, it's also to bring out debates. So I think we can all agree to disagree. So I think that's the value of academic research. Everybody get enlightened.
I enjoy the debate. I appreciate the spirited discussion. Thank you.